Okay, let's dive right into this explainer. We are tackling a massive question today. Is media and cable giant Comcast a deep value opportunity of a lifetime, or is it a dangerously deceptive value trap? We're going to tear down the fundamentals of Comcast Corporation, the absolute behemoth behind Xfinity, NBC Universal, and Sky, to figure out exactly what is going on beneath the surface.
Now, right off the bat, the sheer paradox of these numbers shows you exactly why this is such an incredible financial mystery. On one side of the ledger, you've got a massive $900+ billion enterprise boosting a mouthwatering 4.8 times price to earnings ratio and a hefty 5.24% dividend yield. But on the flip side, you're staring down the barrel of a frankly terrifying $946 billion in debt, plus a recent quarterly loss of 167,000 broadband customers. It's literally a divided scenario, a dividend investor's wildest dream clashing directly with a growth investor's absolute worst nightmare. Section 1. The illusion, a flawless valuation on paper.
So, the absolutely crucial point to understand here is that on paper, this behemoth is priced for extreme pessimism compared to its peers. The metrics are wild. At around $25.17 a share, which, by the way, is a steep 23% drop from its 52-week high of $32.86, Comcast is trading at a PE of just 4.8 times earnings, all while sporting a solid 12% return on equity. To put that into perspective, Disney is sitting at 16 times, and even Verizon is at 9.5 times. You are looking at a nearly 21% earnings yield. If you're a strict value investor, these numbers are practically screaming your name.
Section 2. The reality check. Uncovering the red flags. To really understand the discount, we have to look at the massive red flags, starting with this number, $946 billion in debt. I really want that staggering debt figure to sink in for a second. This massive debt load pushes Comcast's debt-to-equity ratios somewhere between 100 and 110%. So, why does this matter to us? Because carrying nearly $1 trillion in debt severely limits their financial flexibility, restricts their ability to make large-scale acquisitions, and frankly, leaves them incredibly sensitive to interest rates in a shifting macro environment. Then there's the brutal reality of what we call cord-cutting 2.0. Comcast's most profitable business is bleeding customers to fierce new technological competitors. We aren't just talking about people canceling cable TV anymore, though, to be fair, they did lose 280,000 video customers in Q2 of 2026 alone. The real alarm bell is the loss of 167,000 domestic broadband customers in that exact same quarter. Following a year where over 1 million customers abandoned their internet service in 2025, it's obvious they are losing serious ground to cheaper 5G fixed wireless from Verizon and T-Mobile, aggressive fiber expansion from AT&T, and new satellite internet options.
And of course, this customer bleed directly hits the bottom line. Even if we exclude the massive one-time $9.4 billion gain they had last year from selling Hulu, the profit collapse is glaring. Without that Hulu money, net income fell a devastating 68.3%. In fact, looking just at Q1 of 2026, net income still dropped 35.6%. This proves the profit collapse is a disturbing trend, not just some one-off blip. Add to that a completely stagnant top-line revenue growth of a mere 1.5%, and you can really see the structural strain on the business.
It's no wonder the street is highly cautious about these deteriorating fundamentals. We've got insiders selling rather than buying, and analysts slashing targets below the current price. Guru Focus specifically flags Comcast as a possible value trap, with a mediocre score of 63 out of 100, even though they calculate a fair value of $37.30. Broadly, analysts rate it a hold, with Rosenblatt recently cutting their price target down to $24. Plus, the stock literally just scraped a 52-week low of $21.28 on July 24, 2026. When management has basically zero skin in the game and Wall Street is stepping back, you really have to ask yourself if the fundamentals are completely broken. Section 3. The silver lining, the hidden green flags. But hold on, because just when you might think this stock is down for the count, we pivot to some undeniable green flags. Comcast isn't just a dying cable company. They actually have multiple, massive, highly profitable avenues for growth. Their revenue is heavily diversified, way beyond just broadband. They own NBC, Universal Pictures, the rapidly growing Peacock streaming service, Universal theme parks, which are absolute cash engines, by the way, and Sky's European operations. This diversification is a major defensive wall against that entire cord-cutting narrative.
And we have to talk about the sheer cash power of this business. You are literally buying sales for pennies on the dollar here. We're talking a price to sales ratio of 0.65 times, while gaining access to a business that throws off over $20 billion in free cash flow every single year. With a price to free cash flow of just 4.65 times and a staggering 24.7% owner earnings yield, the cash generation here is the kind of metric you typically only see at absolute market bottoms.
The smart money is definitely noticing this defensive cushion. Hedge funds like Greenlight Capital have been buying in at $23.91 to capitalize on what they see as a 5x EBITDA opportunity. Look at the yield, a highly secure 5.24%, paying out $1.32 per share, backed by a very comfortable 35% payout ratio. When you combine those dividends with stock buybacks, the total shareholder yield jumps to around 13%. Plus, it's got a beta of 0.65, meaning this stock is roughly 35% less volatile than the broader market, offering a much smoother ride. Over 30 major institutional investors are closely guarding their positions here.
Section 4, the Titan Tribunal, Graham, Lynch, and Buffett.
Let's put Comcast through the ultimate stress test using the frameworks of 3 investing legends. Benjamin Graham gives it a mixed score of 35 out of 100. He likes the valuation, but absolutely hates the debt, as the 0.9x current ratio and debt to equity fail his strict balance sheet tests. Peter Lynch fails it entirely, scoring at 30 out of 100, because despite a highly attractive PEG ratio of 0.32, his framework requires at least 10% revenue growth, making Comcast's stagnant 1.5% top-line growth a total deal-breaker. Finally, Warren Buffett gives it a partial pass of 46 out of 100. He loves the incredible 70% gross margins and massive owner earnings, but he definitely balks at the low 6.32% return on invested capital and worries about the durability of the business model.
Section 5, the moat debate. Is the advantage eroding? This brings us to probably the most critical part of the thesis. Is the protective moat around Comcast's core business actually surviving? Both Morningstar and Guru Focus, who gives it a solid 7 out of 10 for profitability, agree that the massive infrastructure scale and regulatory barriers still grant Comcast a top-tier competitive advantage. Serving 65 million homes creates incredibly high switching costs. That sheer physical scale of their network, combined with the immense brand power of Xfinity and NBC Universal, gives them what's classified as an entry-level wide moat, placing them in the top 1.3% of all telecom companies. But here is the billion-dollar question. Is that historic moat under attack? For the first time in decades, cable broadband is facing legitimate, cheaper, and faster alternatives. The historic monopoly over your home's internet connection is completely breaking down. When a consumer can literally just plug a 5G wireless box into their wall for less money, or get symmetric fiber speeds from a competitor, that wide moat suddenly looks a whole lot shallower. The infrastructure is undeniably valuable, but the technology landscape is fundamentally shifting beneath their feet.
Section 6. The final verdict. Deep value or deep risk?
If you are an aggressive investor willing to bet on a turnaround, you need to mark your calendars for 2 extremely critical dates to see if they can stabilize their broadband base and maintain that massive dividend payout. October 7th, 2026 is your deadline if you want to capture that juicy 5.24% yield. But October 28th, 2026 is the real test. That's the next earnings release, where we'll see if the bleeding of broadband customers has finally slowed or if cord-cutting 2.0 is actually accelerating. So I'm going to leave you with this final thought, and I want to hear your take on it. Are you stepping in to buy this historically cheap $20 billion cash machine, or are you staying far, far away from a business in structural decline? Is this the ultimate Warren Buffett value play, or just a classic value trap waiting to spring? The risk-reward here is immense. Thanks for joining me on this explainer. Keep doing your homework, keep digging into the data, and as always, keep learning.